In the fall of 2008, the global financial system fractured. Millions lost their homes, and the very banks responsible for the collapse were bailed out with taxpayer money. Out of that exact moment of systemic failure, an anonymous programmer released a piece of code meant to bypass the entire banking apparatus. The original blueprint was an act of digital rebellion. The goal was to build a peer-to-peer network without leaders, without borders, and completely free from the middlemen who had just broken the economy. For the first decade of its existence, the traditional financial elite treated this new network like a punchline. Asset managers and bank executives went on television to dismiss it as a pyramid scheme, a volatile tech bubble, and internet magic that would inevitably, eventually crash to zero. The head of the world's most powerful asset management firm publicly labeled the technology an index for money laundering. But today, the exact same institutions that spent years trying to discredit this network are now its biggest holders. They have built the infrastructure to capture, store, and sell it to the masses. By taking control, Wall Street positioned itself to manage the trillions of dollars now flowing into the market, shifting the governance of the asset from decentralized code to corporate boardrooms. The mechanism they use to capture this market is a specific financial instrument called an ETF. An ETF, or exchange-traded fund, is a type of pooled investment security that operates like a mutual fund but trades on a stock exchange, allowing investors to buy shares of an asset without actually having to hold or store it themselves. For over 10 years, the United States government acted as an impenetrable barrier to this idea. Regulators routinely rejected every single application for a spot crypto ETF, refusing to let the asset integrate with traditional brokerage accounts. And the government had a valid argument. The crypto ecosystem was notorious for severe price crashes, offshore exchanges operating in the shadows, and billions lost to unregulated fraud. The regulatory stonewall held firm until the largest legacy asset managers decided there was too much money sitting on the table to ignore. This chart shows the combined assets under management of BlackRock, Fidelity, and Vanguard stacked up against the total cryptocurrency market cap. The legacy titans controlled tens of trillions of dollars, a scale of leverage completely dwarfing the entire digital asset industry. Armed with unlimited legal resources, these firms backed a wave of court battles. They cornered the regulators in federal court, won the lawsuits, and forced the government to finally approve the funds. Almost overnight, the corporate narrative completely reversed. The same executives who had labeled the technology a criminal enterprise were now going on television to praise it as the natural evolution of digital gold. Wall Street didn't suddenly discover a deep philosophical belief in decentralized technology. They realized that by packaging a volatile, complex asset into a familiar, heavily managed product, they could collect millions in management fees every single day. The ETF acts as an armored bridge for the average investor. It completely removes the friction of owning crypto. No need to understand complex cryptography, buy specialized hardware wallets, or worry about losing passwords. This diagram shows exactly what happens when you buy a share of a spot ETF on your phone. Your cash moves from your standard brokerage app directly to a traditional asset manager, who then purchases the raw cryptocurrency and locks it away in a centralized institutional vault on your behalf. Because the asset is now held within the traditional banking infrastructure, your investment falls under federal protection. Specifically, it is backed by SIPC insurance, which is a federal mandate that protects customers against the loss of cash and securities up to $500,000 if their brokerage firm fails. With that safety net in place, the market reacted immediately. The newly launched spot fund shattered Wall Street records, absorbing billions of dollars to become the fastest-growing ETF in financial history. Following that success, Ethereum successfully pushed through the exact same regulatory door, stripping away its lingering legal risks to sit right alongside Bitcoin in the traditional financial markets. The demographic buying these assets completely flipped. The market moved away from young tech enthusiasts trading on offshore websites to massive legacy pension funds, corporate treasuries, and everyday 401k retirement accounts. The code, originally designed to bankrupt the middlemen, survived its most difficult years, only to be completely absorbed by them. The anti-bank rebellion succeeded in creating a new financial asset, but in the end, it was Wall Street that cashed the check.